Now, Finance Minister Malusi Gigaba has amended the money laundering and terrorist financing control regulations and withdrawn exemptions made in terms of the Financial Intelligence Centre Act. Mr. Raymond Masoga, who is the Director for Financial Integrity in Tax and Financial Sector Policy Division from Treasury, joins us live from our Pretoria studios. Thanks so much for your time on SABC News. In simple terms, what does this amendment mean?
Thank you very much, and good afternoon to you, to the viewers. The amendments are part of the broader amendments that we have made to the Financial Intelligence Centre Act of 2001. What we seek to do is to modernize our anti-money laundering legislation and the combating of financing of terrorism to make sure that we align with international standards, but also to make sure that we tighten the enforcement and also the protection of our financial system through making sure that we strengthen our laws so that the accountable institutions or financial institutions and other professional bodies like the attorneys and estate agencies could be able to identify and verify their clients in such a way that they'll be satisfied that they know who they are dealing with when they do business.
Mm-hmm. This change means a more risk-based approach. You've also spoken about modernizing how institutions do due diligence on customers. Does this apply only to new customers, or all customers will be subject to these changes as well?
It is going to apply to all customers, but then we have a transitional mechanism which will then enable institutions to be able to implement the changes in such a way that it does not interrupt their normal business. So the most important thing would be that when you start with new customers, then you will start implementing the changes. But over a period of time, institutions then will be allowed some time to then update their records in as far as the old customers are concerned. Part of what is good about these changes also is to simplify how members of the public as well comply with the law. As you recall that the law that we just amended more often required people to produce a proof of residential address and utility bills, which has been a problem for most people because not everyone will have such documentation readily available. So now we are making it easier for financial institutions and other entities to find more innovative ways in which they can identify and verify their clients without burdening the public broadly, but also for them to be able to find a cost-effective way of identifying their clients.
Mm-hmm. Part of the amendments also say that institutions should determine what constitutes a single transaction in the context of their own business and provide for the application of a single transaction threshold insofar as they accommodate such transactions. Why is this important?
Okay, so the amendments also introduce what we call a risk management and compliance program, which institutions should have as part of their internal controls. So this is what we call in the legislation the introduction of a risk-based approach, which changes the approach to how we supervise money laundering and the terror financing. So a single transaction threshold, what it does is to basically set a threshold below which financial institutions and other entities do not have to go to length to verify the identity of their clients. So in other words, it simplifies also those smaller transactions which are not necessarily imposing risk to the financial system. You would normally be aware that from time to time, if you travel out of the country and you just landed at the airport, you want to change the foreign currency that you have, irrespective of the amount involved, you'll be required to produce your utility bills and all these requirements that stringently have been required. So now we are making it easier that once a threshold is set, you can be able to do certain transactions, for instance, that are below that threshold, but also it particularly refers to instances where you don't necessarily establish a relationship with the financial institution, but you do a once-off transaction. A person would do a sort of a temporary job or odd job here and there and is paid, for instance, with a cash check and wants to just run into a bank and cash the check, but doesn't have to open an account with that financial institution. So that person, you don't necessarily have to go to great length to identify and verify. You can just have a mere identification in the form of an ID or a name, but you don't have to go to length to do the verification as it was the case with the previous legislation.
Now, obviously, when you're trying to make systems easier for both the clients and the institutions, there will be people who will try and skirt around these issues, perhaps lowering the threshold of the amount of money that you can transact with, and also making it easier for people to not have to come in with utility bills. So what balances do you have in place to counter that?
Now, this risk management and compliance program that I just referred to, so it allows institutions themselves to design mechanisms that broadly cover how they intend dealing with various situations that may arise when they deal with their customers. Firstly, it will have to cover instances where you have to decide at what stage a customer, for instance, is a once-off customer or will become a regular customer, or you build a relationship with that customer. And in that program also, it will indicate how they will deal with various instances where customers are not able to comply in terms of the requirements. But because we do recognize the fact that a risk-based approach is a new approach in the financial sector in terms of the anti-money laundering legislation, the supervisors themselves will work together with the institutions to make sure that they assist them to get to a point where they are able to enforce the law in such a way that it strikes the right balance. As you would have noticed also from the statement, we make reference to the issuing of a guidance note by the FIC. That guidance note also assists institutions to be able to find a balanced mechanism in which they can be able to understand what exactly is expected of them in terms of the legislation. Because from time to time, there may be instances where there's a differences in interpretation in terms of what institutions need to, various institutions need to do in respect of the outline, and also in terms of what clients expect should be their obligations when they do transactions with institutions. So the guidance assists in respect of such matters where there is no clarity. They seek to then provide that kind of clarity.
Raymond Masoga from Treasury, thanks so much for your time on SABC News.